Hi everyone, welcome back to the US CPA classes for regulation exam. In this particular video of federal taxation on property transactions, I'll be discussing in detail about special section, that is section 1231. Yes, market. This is one of the important section for your practice purpose as well as for exam purpose. It comes under the cost recovery. So we'll be discussing gain or loss from section 1231, assets, depreciation and recovery allowance or the recapture of the depreciation under section 1231. So let's dive into to understand everything about section 1231.
Today, like in first half, we'll cover these two important topics, which is gain or loss under section 1231 assets, and then depreciation and recovery allowance recapture. So these two topics we'll cover before the break, and after the break, we'll jump onto the chapter 5, right? So you have all these notes with you. Hope you all might have gone through it, right? So just quickly scrolling so that yes, you can recall what all we have studied in last couple of weeks. Right, so this is about like division of land. If you remember, this is about assets, basis and holding period. Then we have discussed about these questions also, then stock split and stock dividend, then the capital loss limitation, capital gain or loss limitation, disallowance, netting of process, cost recovery in depreciation. We have discussed both convention methods, like for real estate, mid-month convention method, and for personal property, we discuss about mid-quarter and half-year convention method. Then we discuss about bonus depreciation and alternative depreciation method as well. I think till page number 32, yeah, amortization also we have covered in last class, and we have covered depletion also. Till page number 32 we have covered. So I have shared from page number 33 to 44 with you in the WhatsApp group. So hope you guys have downloaded that. Have you all downloaded the notes for today class?
Yes, sir.
Okay, so this one is very important. I would say you can mark this as very important topic. In this 1231, there are 4 sections which we'll be studying together. The first one, main umbrella section, is 1231, right? So under 1231, we'll be studying section 1245, 1250 and 291. So these are the 4 sections. Always you need to study together holistically as a one umbrella of these 4 sections basically, right? So before jumping into this table, like let me take you through the oral definition of these respective section and overall, gist of these sections, so that when we come back to the table, you can comfortably connect the respective dot, what this respective section is talking about, and how they need to be looked at in a single glance in its interrelated topics or interrelated sections, right? So the first section which I was telling you is an umbrella section. So section 1231, right? How do I remember generally this? Like December 31st. So it's easy to remember. 1231 is December 31st, right? The next section is 1245. So 1245, how do I remember generally? Is quarter to one, like near to lunchtime. So that's how it's easy to remember. Third one is 1250. You are getting more closer to lunch. It's just 10 minutes or one, right? And the last section is 291. So, right, these are the 4 sections we all always will be studying together. Also, interrelated section or a group section. 1231. 1231 section is for the property which is real property or depreciable business property. Do you remember what is real property? Any of you?
Yes, sir, which is visible like land and building.
Yeah. So real property is that property which is land or anything permanently attached to the land, or growing over the land, right? So that is called real property. Other than real property, all are movable property, right? So all movable property which is being used for business purpose is called personal property. What we call it? Personal property, right? So if you remember, like when we have started this chapter, at that point of time, I also informed all of you, and I'm reiterating the same thing, that Indian student most of the time get confused about the personal property, right? So personal property does not mean it's your like you're using it for personal purpose, like for example your mobile, car, or something like that. So here personal property mean the movable property which is used for trade and business, right? So these are like two categories of assets. Section 1231, property include real property or depreciable business property. So it covered both, held for more than 1 year. That means more than 1 year mean holding period is more than 12 month. That is holding period is resulting into long-term capital assets, right? Makes sense? So far so good. First line.
Yes, sir.
So example could be land, building, machinery, equipment, timber, livestock, leases, etc. Section 1231, gain from sale of property is treated at the lower capital gain tax rate versus the rate of ordinary income. So if you remember when we started this class, I informed normally the capital gain tax rates are lower compared to ordinary income tax rate. Ordinary income are generally taxed in a range of around 25%, whereas like capital gain are being taxed in a range of 10 to 15%, right? So hence people are being more inclined that their income should fall under the bracket of capital gain so that they have to pay less taxes, right? So, if you see the section 1231 gain from sale of property is taxed at lower capital gain tax rate compared to or versus the rate for ordinary income. If the sold property was held for less than 1 year, 1231 gain does not apply. So 1231 gain or loss provision applies only to the long-term property, not to the short-term property. That means if you are holding any property for less than 12 months, then 1231 is not applicable. If your holding period of the property is more than 12 months, then only 1231 will be applicable. Clear so far? Any doubt? Yes, no,
Yes, sir.
right? So second section is 1245. How we remember this? Quarter to 1, right? So section 1245 deal with tangible or intangible property that are going to be depreciable or get amortized. And this provision recapture the gain as ordinary income to the extent depreciation is deducted. And it applied to personal property, which is like machinery, equipment, furniture, automobile, computers used in trade or business. So what section 1245 is saying, that to the extent you have charged depreciation on property, right? First, up to that amount, first your gain will be considered as ordinary gain. After that, if you have any gain, that can be considered as a capital gain and taxed at a lower tax rate, right? Next section is 1250. 1250 address the taxing of gain from sale of depreciable real property, right? So 1245 was for personal property or intangibles, but 1250 is only and only for real property. What is real property? Land and anything permanently attached to land or growing over land, right? Such as commercial building, warehouse, barns, rental property, and their structural component at the ordinary tax rate. However, tangible and intangible personal property and land acreage do not fall under this tax regulation. So 1250 does not include movable property, it includes only immovable property, which is real property. Clear? So far so good? Or shall I explain through an illustration or example?
Yeah, that would be good, great.
So maybe
Sir,
if yes.
sir, this 1231 and 1245. So I am not able to understand. Like in 1231, we are saying real property or depreciable business property,
Both.
uh, which is which is held for more than 1 year.
Yes.
So in 1245, again we are talking about the depreciable properties, whether intangible or uh, tangible. So in this case, the property is held for less than 1 year.
No, for more than 1 year.
In 1245 also.
This is like junction of the section 1231, 1245, 1250, and 291. You need to look at like together. So all things we were discussing is for more than 12-month assets.
So, section 1245, please explain with an example.
Yes. Yeah,
Yes,
1245 and
that would be
1250
helpful.
both. So the difference
Yes, sir.
between 1245 and 1250 is 1245 is for personal property, which is movable property, and 1250 is more relating to real property, right? So once like let's look at 291 also, then I'll explain through an illustration. Just give me 5 more minutes just to take you through the theory section, and then I'll do an illustration for you. Section 1245 and 1250 were enacted to close the loophole that resulting from allowing depreciation deduction on the assets to offset ordinary income while taxing gain from sale of these depreciable assets as a capital gain. Last one is section 291. So section 291 contain additional depreciation recapture rule applicable solely to the corporation which dispose of depreciable real property. This recapture is in addition to recapture of the first calculation under 1250. So to 1250, 1245, 291, they all are talking same language but for different property, right? They all are impacting the depreciable asset to the extent depreciation has been charged. So recapturing of depreciation need to be considered as ordinary income but not the capital gain. So this is what it means. So for example, maybe if you can note it down an example, I can illustrate through. For example, on 1st January 2020, if you can note it down an example, 1st January 2020, company has purchased a machinery for $100,000. On 1st January 2023, company has purchased a machinery for $100,000, right? On 1st January 2023, 1st January 2023, company is selling this machinery. Company is selling this machinery for 80,000. Life of the machinery at the time of purchase, life of the machinery at the time of purchase is considered 5 years. Right? And let's assume the depreciation is straight line method of depreciation. Right. So calculate the gain and loss on sale of this property. Calculate the gain or loss on sale of this property. Right. So the example which we have written, I have just summarized here. 1st January 2020, the purchase was $100,000. Right. On 1st January 2023, the sale is for $90,000. Depreciation is 20%. Right. Life of asset was 5 years. And asset uses how many years? 2 years, right? So what is the WDV of asset at the time of sale? Huh? What is the WDV at the time
60,000.
of sale?
60,000.
Everyone agree? 60,000? Any doubt so far? Yes or no? Are you guys here with me?
Yes.
Yes, sir.
Right. So the written down value is 60,000. So depreciation charge is 40,000.
40,000. Yes.
Clear everyone? And now what is the gain?
30,000.
90,000 minus 60,000. Yes or no?
Yes, sir.
Right. So this gain, they are talking about this gain is coming from where? So initially, when you purchase the asset and you charge the depreciation, so depreciation is allowable expense. Yes or no?
Yes, sir.
Depreciation is allowable expense, right? So in the first year and second year, you have reduced the depreciation up to $40,000 and you have taken the tax benefit. You have paid less taxes, right?
Yes.
So now if you are receiving any gain, so will that gain need to be taxed at a capital gain tax rate, or shall we consider that to be taxed at an ordinary income rate? Right here, the lawmakers say to the extent you have availed the benefit of depreciation, right? So your tax rate, the benefit which you have taken is ordinary tax rate, right?
Right.
So now to that extent, gain should be adjusted against ordinary income, not a capital gain income, right? So this 30,000 will go as a considered as ordinary income.
Okay.
Make sense, everyone?
Sir, I have a doubt.
Yes, please.
Yeah, sir, why we have taken asset used as 2 years? I think we used it for 3 years, right? 2020, 2021, 2022.
Oh, okay. Yeah. Sorry, my bad. My
Okay.
bad. Yeah. Sorry. So now the this will change. Yeah. Thanks for correcting. So 60,000 will be depreciation.
Yeah.
Right. So your gain will be 50,000. Right. Now thanks for correcting, Matthew. Right, everyone? Clear? Now let's assume this asset has been sold for 120,000. Let's assume this asset is being sold for $120,000. So written down value is same, 40,000. What, and depreciation is also same, 60,000, right? So what is the gain? 120 minus 40,
Yeah.
right? So out of this gain, They're saying you need to identify how much you have charged against depreciation, 60,000, and remaining balance should be considered for capital gain.
So this 20,000 will be considered for capital gain?
Yes, so this 60,000 will go for ordinary income, and this 20,000 is capital gain at lower tax. Make sense? Clear, everyone? Shambhu,
Yes,
Anuradha, Matthew?
Sir,
Yes,
sir,
sir.
this example relates to section 1245, right?
Yes, this is for movable property. Yes.
Okay.
So 1231 along with 1245. If we say this is immovable property, then it is 1250 and 291. So I'm coming to that. So as of now, conceptually, you all understand when we need to treat as an ordinary income and when we need to treat as a capital gain. So basic fundamental is clear. Then we can come back to which section apply to which category.
Yes.
Now let's come back to the notes. So now we can come back to this. Section 1231. Gain and loss under section 1231. So sale or exchange of real property or depreciable business property, which is movable property, including involuntary conversion used in a trade or business, are held for more than 1 year. It may either result into a gain or it may result into a loss, right? So when you're selling any asset, it may give you either gain or loss, correct? So when it is resulting into gain, so there are three sections which you need to be considered. First is 1245 if it is a personal property. Personal property is machine, equipments, or any other movable property used for trade and business. But if it is a real property, at that point of time, you need to identify the ownership. If the taxpayer is individual, then section 1250 will be applicable. If the owner is company C corporation, then section 291 will be applicable. But provisions for both are same, right? So whatever the provision we have discussed, like how much depreciation we need to be recaptured as ordinary income, and after that any gain need to be considered as capital gain at a lower tax rate. But the provisions, the sections are different. For all kind of personal property, there is one section 1245. But for real property relating to individual, it is section 1250. Relating to C corporation, it is 291. So far, so good? Yes, no?
yes.
So far, so good, everyone? Right? So the recapture of gain is same like the example which we have discussed, whether it's 1245, 1250 or 291, right? So you need to consider how much was the purchase cost, how much is the depreciation charge, what is the written down value, at what price it is sales minus written down value, it may result into a gain or loss, right? So that gain to the extent of depreciation recapture would be considered as ordinary income. Over and above, if there is any gain, that gain will be considered as capital gain and taxed at a lower tax rate, right? So if you see, gain is equal to ordinary income to the extent 100% of accumulated depreciation on asset. Make sense? Yes, no? Right? For all this scenario, the calculation will be same. Gain to the extent of depreciation will be considered as ordinary income. Over and above will charge at a lower tax rate. Right? The amount equal to or lesser of the recognized gain on the sale of section 1250 assets or accumulated depreciation is taxed as a maximum tax rate 25%, which is the ordinary income tax rate. Gain or loss on ordinary income to the extent of 20%, lesser of recognized gain or accumulated depreciation will be charged at 20%. Because for C corporation, the corporate tax rate is 20%. Right? The remaining gain or loss is treated in section 1231. So this is the treatment of gain. On the other side, if there is loss, the loss are netted with the section 1231 gain. So maybe for some assets you may have gain, or for some assets you may have loss. So first, the loss you have, you will net off against the gain with some other property if you have, right? If there is still remaining loss, then that loss can be carried forward. That loss can be carried forward as ordinary loss. And if there is any gain, that gain can be adjusted against the 1231 loss in the any earlier year, right? If the resultant is net 1231 gain, then treat this as an ordinary gain to the extent of uncaptured depreciation, uncaptured 231 losses in the previous 5 years. And the rest remaining, if there is any, that will be treated as long-term capital gain, because it is always beyond asset which you are holding more than 12 months, right? If the result is net 1231 loss, then treat that section 1231 loss and you can carry forward. So let me quickly summarize the loss section again. So on the loss side, first thing what you need to do, there may be, let's assume 5 assets you are selling, right? So out of those 5 assets, on 3 assets there are gain and on 2 assets there is loss. So first, within the same year, you will net off, right? So let's assume net result of these 3 gain and 2 loss, it may be total net gain or it can be total net loss, right? If it is a total net loss, that you can carry forward as a section 1231 loss for the future period. But if there is net capital gain under section 1231 for the current year, so first you can adjust from the previous 5 years if there is any 1231 loss, so you can adjust against that. If still there is some remaining gain, that gain can be continue to be treated as long-term capital gain and should be taxed at lower tax rate. Shall I do an illustration for this? Or is it comfortable to everyone?
Yes, sir.
What? Comfortable or illustration?
Illustration.
Yeah, be specific. Okay, so let's assume year 3. Let's assume we are at year 3. In year 3, there is 1231 asset 1, 2, 3, 4, 2, 3, 4, 5. So this is, let's say, scenario 1. And this is, let's assume, scenario 2. So this is like gain I'll keep in positive and loss I'll keep in negative. Let's assume there is a 50,000 gain and in asset 1, and let's assume 100,000 gain in asset 2, but you have loss of $200,000 or maybe 30,000, sorry, minus 30,000 and minus 70,000. Right. So let's assume on asset 1, 2, 3, 4, 5, this is a position in scenario 1. In scenario 2, let's assume you have this. Let's assume remaining is same. So first what you will be doing within the same year, you will be adjusting. So all you need to do net. Right, and here it may result into gain. Right, clear so far? So first you need to do within the same year netting procedure. And let's assume in earlier year, $1231 loss carry forward is let's assume $100,000. So that can be again scenario 1, or on the other side it can be gain. So these are two scenarios for the earlier year carry forward, right? So in the earlier year, sorry, gain will be taxed as long-term capital gain. Sorry, my bad. Gain will not be carry forward because gain would have been taxed as a long-term capital gain in that year, right? So here, net 1231 carry forward adjustment. How much will it be? This plus this, right? And what will be here is this. So this will be treated as long-term capital gain, and this can be carry forward. Clear?
Yes, sir.
Shambhu, Matthew, Sadaf, better?
Yes.
So first, like within the same year, different assets relating to 1231. So first you need to net off within the year. Then in the earlier year, if there is any loss, so first you will be adjusting against the earlier year loss, or you can adding into the earlier year loss, and it will be resulting into carry forward 1231, right? But after the adjustment, if it is resulting into a gain, so that gain will be treated as long-term capital gain and should be taxed at a lower tax rate. So this is what it means. If the result is net 1231 gain, which is this scenario, right? As then treat as ordinary gain to the extent of recapture losses in the previous 5 years. So this previous, so we are here. So to this extent, you will be recapturing, right? If even after that, the rest is treated as long-term capital gain. If after that there is any remaining profit or gain, that will treat as long-term capital gain. Clear? Treat like extra depreciation you should have been allowed. Clear? Section 1231, 1245, 1250 and 291.
Yes, sir.
Okay, I think there may be a question. Yeah, there are 2-3 questions. Okay, let's do some practice. The taxpayer purchased a forklift for use in the taxpayer business for $20,000, right, on January 1 of current year. The taxpayer sold the forklift for $22,000 in June 1 of the current year. What is the taxpayer section 1231 gain as a result of the sale? So which one is right? Have you understood the question? Have you guys understood the question, or shall I repeat? All of the question is, a taxpayer has purchased the forklift for the use of business for 20,000. Which date he has purchased? January 1, right? And he has sold at 22,000 on June 1, right? So the holding period is how much? Less than 12 months or more than 12 months?
Yes, less than 12 months.
So will section 1231 applies?
No.
So what will be the answer?
0.
0. Right? Make sense, everyone? Shambhu, Sam, Giri, clear?
Yes, sir.
Right? Next question. So these are the question actually which we have taken from the last couple of your actual examination of AICPA. So this type of question will be coming in your examination, right? The sale of which the following type of business property should be reported as section 1231. The sale of which of the following type of business property should be reported as 1231. Property used in the trade or business and involuntarily conversion. First is inventory held for resale, machine held for 6 months, cattle held for 6 months, land held for 18 months. Which one should be considered as 1231? Is inventory considered as 1231?
No. No.
Right? No. Machinery less than 6 months? No.
No.
Right? Cattle for 6 months? No. So
No.
which one is
No.
correct?
Land held for
But land
And building?
land is not depreciated.
Yeah, but that is still a real property. Even
Okay.
though it's not a depreciable, but it's a real property.
Okay.
Okay, so last topic of chapter 4, depreciation and recovery allowance recapture. So, which we have already discussed, section 1231, 1245, 1250 and 291 above for the tax treatment of recapture. So, the terminology uses recapture of depreciation. That means the depreciation allowance which you have taken earlier here, now you are adjusting that against the gain. So, that is called recapture of depreciations, right? Please underline and mark this word, right? Depreciation recapture rule does not apply when the property is disposed of by gift. If you are giving any property as a gift, then section 1231 does not apply. And in case of death also, when you are transferring in case of death. So in these two scenarios, 1231 does not apply. When transferring any property as a charitable contribution, consider fair market value of the property as a charitable contribution deduction. Right? Charitable contribution deduction at the time of contribution when you are making, when you are transferring the assets. So that time, what is the fair market value of respective asset which you are contributing, that you will be using. Gain on tax-free exchange or involuntary conversion, ordinary income up to the depreciation deduction taken in earlier period, capital gain above the depreciation amount. So, to the extent of depreciation amount, it is recapture of depreciation, and ordinary income over and above, it is capital gain. Next is installment sale. Any depreciation is recognized in the year of sale, even if no proceeds are received. So, installment sale, do you remember installment sale from your school days, college days? Any idea? Any idea what is installment sale? No? Anyone by any chance have some idea from your school days, college days, where you have studied installment sale, or no idea at all? Okay,
Like
no
a
worries.
situation where like the company does not have any money or any form of assets to meet their debt, debts or liabilities.
No, Arjun. Installment sale is, for example, like, uh, let's assume any electronic shop, right? They are into sale of, let's assume AC and refrigerator, right? So there are many
Okay.
people, or maybe like cars dealers, right? There are many people who wants to buy the car, AC, or maybe refrigerator, right? But they do not have like full cash with them. Nowadays, we take the help of bank and convert into EMI. But if the owner of the car,
Yeah.
owner of the refrigerator or AC they are providing like flexible payment plan. It's an installment plans, right? So and that kind of sale are considered as installment sale, where bank is not involved, but the party are directly entering into an arrangement of installment sale that seller buyer can pay in an installment method, right? So that is called installment sale. But in installment sale, the ownership of the asset will remain with the seller unless and until last installment is received. To the extent last installment
That
is
is
not received, the ownership will still remain with seller.
hire
Yeah,
hire
Prakash?
purchase.
Yes, yes, yes.
Uh,
Yes,
so
yes,
it is similar like hire purchase. Okay.
absolutely, 100% same, 100% same, right? And here the seller has the right to repossess the asset. That means seller can take the asset back if the buyer is not paying installment, right? So in that, for example, any asset which you have purchased, for example, you have purchased a JCB machine, big JCB machine, right? And you are using that machine from almost 2 years now, but now that machine is not in for use, right? And you wanted to sell because it's like 30, 40, 50 lakh or heavy amount, hefty amount, you can say machine. So you're not finding any person who can give you immediate cash, and you have given that on installment sale basis, right? So consider that as an example in mind. Let's look at this example. Equipment purchase. Let's assume you purchased JCB machine on 1st January 2001 for $100,000, right? And on 31st December 2003, you sold this at 110,000 3-year equal installment. That means the buyer will give you 3 equal installment of around 1/3 of 110,000 basically, right? And in 2001 to 2003, before sale, you have charged a depreciation of 60,000. So net book value you have for the asset is $40,000, right? So your gain is $70,000, which is 110 minus $40,000. But $60,000 would go to the ordinary income because that is a recapturation of depreciation. Remaining 10,000 as 1231 long-term capital gain, but that will be recognized over the period of 3 years. That will be recognized over the period of 3 years as and when you are receiving the installment. Make sense? Clear so far? Or any doubt here?
Yes, sir.
Next is 1250 applies to real property. This we have already discussed, land and building. Gain or sale on exchange of real property up to the depreciation taken in earlier period, consider under section 1250 will be taxed at a 25% tax rate, which is ordinary tax rate. Over and above will consider as long-term capital gain, which we have discussed in the above table. Additional rule for C corporation 291, that also we have discussed. C corporation ordinary income from the sale of Internal Revenue Code section 1250, which is real property, will be increased by 20% of the lesser of depreciation deduction taken or recognized gain. For example, the remaining gain will be 1231. So example over here is, one second. Sorry. Example is sales is 110,000, cost was $100,000, depreciation so far you have claimed is $30,000. So net book value is $70,000. So the realized gain is $40,000, right? So in this $40,000 as an ordinary income will be lesser of 20% of depreciation or 20% of realized value. So that will be considered as a ordinary gain, and remaining will be treated as long-term capital gain, which is 1231 long-term capital gain, 40,000 minus 16,000, which is 34,000. Right. So there's a small practical question over here. Right. I think this is last question for chapter 4. and then we can take a small break and we can start with the chapter 5. In 2012, John and Kim John, which is like husband and wife, brought their primary residence for $250,000. In 2023, like after 11 years, they sold it for $550,000, taking the maximum allowable exclusion. Which of the following statement best reflect their tax situation? Okay, so I think this question has one more twist, which is exclusion from the income, which will be coming in chapter 5 actually. So just for your benefit, just for your information, I'll tell you about that. So single, there are like 5 type of filing status, which we'll be studying like after the class. So one is single, second is married filing jointly, third is married filing separately, fourth is head of the household, and fifth is qualified widower. So that we'll be discussing after the break in detail, which is in chapter 5. So what they're saying in that, the primary residence, there is an exclusion of $250,000 for single or $500,000 for married filing jointly couple, right? So that is the exclusion available. So which is coming in 5th chapter, but this question came over here. So just keep that in mind and look at another 4, you can say, options, and then let's try to give the answer. The first is couple is able to exclude up to $250,000. Exclusion is $500,000 for couple. So first option is incorrect. Second is couple is not able to exclude any of the gain. So that answer is also incorrect. Third is couple is able to exclude up to $300,000 and is not required to report the sale on 2023 tax return. So first is exclusion is $500,000 and second he must have to report on tax return. So third option is also incorrect.
Right.
Fourth option is the couple is able to exclude $300,000 but is required to report in the 2023 tax return. So difference, if you see, $550,000 is the sales price minus $250,000 is cost. So what is the total gain?
Right. 300,000.
$300,000. So the fourth one says couple is able to exclude $300,000 because exclusion up to $500,000 is allowed, right? But he or she has to report on the tax return. So that is the reason fourth option is correct. Make sense?
Right.
Clear it, right? So this is all about 4th chapter, which is relating to property.